Hi, this is Stuart Weems, and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. A very quick reminder that tomorrow, Jared McCabe and I are hosting a YouTube live event at 7 p.m. Hope you can join me for that. If you would like to, just register. The link is in the show notes, and we will send you an email with all the details. We're going to talk about the top 5 property mistakes, as in asset selection mistakes. That these are the sorts of things that you absolutely must nail to buy the right property, and you can hold that for many decades and enjoy the fruits of that decision making. Okay, let's get into today's episode, which is another Q&A episode. Okay, so the first question is from YSJ. YSJ writes, I want to take a moment to personally thank you for the amazing work you've done through your podcasts and books. I've been listening to your podcast religiously for the past 4 years, and it's had a tremendous impact on the way I think about and manage finances. Your ability to simplify complex topics and make them both engaging and actionable is a real gift. I recommend your podcast and books to countless friends and family. So thank you very much for the beautiful feedback. It really does mean a lot to me. Hopefully it's obvious I put quite a lot of effort and thinking into this podcast, and I'm really privileged to be able to kind of share my thoughts to so many people. And, if it just helps a few people, I think it's been well worthwhile. So I really appreciate, anyone that writes in with a question. It's great. I love the feedback. It's fantastic. It gives me more energy, I think, to keep doing this for hopefully many years to come. Anyway, YSJ writes, we're exploring the joint purchase of an investment property between 2 siblings and their spouses, so 4 individuals with equal share. The short-term plan is for this to become a family home for our parents when they move to Australia in about 5 to 7 years. A few key questions would love your advice on. I'll just go through these questions one by one. Is it possible to, well, there's probably no other way to do it, Stuart, so that's a stupid thing to say. Okay, is it possible to purchase the property in 4 names with equal ownership? Well, I since published episode 355 to be exact, where I talked about ownership in personal names. And so in this situation, you would own the property tenants in common, with each individual owning 25% of that property. So that's fine. What ownership structures would best protect all parties given their relationships and risk? Well, the tenant in common structure is best because that always goes into the estate and it's very clear where the ownership is. Number 3, can we include a clause in the contract to manage situations where one party wants to sell due to financial stress but the others do not? Would a buyout clause help? So it's interesting. This is kind of the crux of the question, really. What do you need to do and what do you need to put in place to protect everyone? And I think before you go and co-own property with family or friends or whatever the relationship could be, the best thing to do is plan for the worst and hope for the best. So plan for the worst is that people's minds change, that people can't afford it anymore, that there's a relationship breakdown between the parties, all these sorts of things. And you want to talk about all those things up front and decide how you're going to deal with them. And then you would put them into a agreement, and you call this a co-ownership agreement. You could do this, just have an agreement you write between yourselves and sign it. Alternatively, you go to a lawyer and get the lawyer to draft it. Of course, there's going to be additional cost with that, and they might make it a little bit more complex than it needs to be, maybe not necessarily. I think something in writing makes sense. Whether you go to a lawyer and go to that cost and so forth is going to depend, I think, on really the risk and the value of the asset. But that co-ownership agreement should really deal with exit and dispute resolution, valuation, all those sorts of things. So in a ownership agreement, you probably have that, if one party wants to exit their 25% share, that they have to offer it to the remaining parties. Now, if the remaining parties don't or can't or don't want to buy that 25% share, then the property will have to be sold to the open market. And of course, then all owners must sell, because you can't really sell you can sell 25% of a property, but no one's going to buy it. So it's really, you've got to have that sort of drag along rights where if one person wants to sell, the property must be sold. I would probably also include a clause that says something along the lines of if the parties separate, go through a marital separation, that the property should be sold within or must be sold within 6 months of the date of separation, something along those lines. Because if parties go through a separation, it could be years before they actually reach a financial agreement, particularly if it's quite acrimonious. And meanwhile, the other couple that co-own this property will just be dragged along with it and won't be able to necessarily make any decisions. So I'd certainly think about all those sorts of things, put it into an agreement, put it in writing. If there's a high risk or it's a high value property, go off to a lawyer and get them to draft it up. I think it always makes lots of sense. They've asked, how does capital gains tax work? Well, if one person sells their share, it really doesn't really change. They'll have a cost base associated with the share, which is 25% of whatever you paid for the property plus any costs. And then they can net that off or compare that to the sales price and any associated selling costs, if there are any legal fees, these sorts of things. And that's how capital gains tax is charged. So whether you own 100% of a property or 25% doesn't really change the approach from a capital gains tax perspective. The next question is, can our parents be listed or treated as tenants once they move in, even though they won't have an income and can't pay any rent? Rent paid from them would come from pooled family funds. We're not trying to dodge the tax office, but want to understand the best scenario and what's above board. Can a tax advisor help achieve this? Yeah, probably a tax advisor can help. I mean, what you want to probably do is make sure that you maximize your negative gearing benefits. I don't know what your incomes or all the four owners' incomes are, but you probably want to do that. And so whether you put it in, 25% each, that you would do that if everyone was on the similar sort of income level, or whether, one husband and wife or one spouse, I should say, group want to own equally between themselves or just one spouse own it. Again, you just want to think about what's going to achieve the best tax outcome from that perspective. You need to then also think about land tax, if there's any land tax considerations, these sorts of things. So I think that makes sense. Then if I'm going to have my parents occupy a property, what I would do is I would rent it to them. I would pay a managing agent. So it's all above board. It's going to cost you, I don't know, 7 to 10% of whatever you're charging in rent. So there's a fee that goes with that, but at least it makes sure it's all above board. You need to charge them a market level rent, but it can, a market level rent could be expressed as a range. So, it might be $500 to $600. Well, you charge them $500. So still market level, but maybe at the lower end. And then, if you as a family want to make those rent payments, there's nothing that stops you from a ATO perspective in terms of giving your parents the money. There's no tax consequences, nothing wrong with that. You can do that. And at least then the owners of the property will then be able to enjoy the full negative gearing benefits associated with that. So keep it all above board. And whether your parents were occupying it or whether it was a unrelated third party, the tax outcome is going to be exactly the same, right? It's really just you're paying for your parents' rent. Nothing wrong with necessarily doing that. You just probably don't want to make it look too contrived. So if you're charging them $500 a week in rent, don't transfer $500 a week into your parents' account. Instead, maybe give them $20,000 every sort of 9-ish months or whatever it is. I haven't done the math in my head, but just give them lump sums irregularly. That can be your gift rather than it aligning perfectly with the amount of rent that you charge them on a regular basis. Final question, are there any other legal, financial, or tax risks that we need to consider up front? That's a nice catch-all question there. Look, I think the main things are just making sure you have a clear idea on how you're going to deal with the ownership. It might be something, well, you're going to own this property for as long as your parents are alive and then you're going to go and sell it. I guess here, where there's co-ownership, it's for a specific non-financial reason, so it could have a higher probability of working. But I know that in my experience where I've had clients co-own property with either friends or family, it's never worked perfectly well longer term, but that's when it's just been purely for a financial perspective. But, get that agreement in place and then tenant the property, in a way that's, at an arm's length basis. So you're going to maximize the tax outcomes. And I think if you're able to do those two main things, you're well in front. But thanks, YSJ. I appreciate the question. Okay, next question is from Pete. Pete's question is, my wife and I own 3 investment properties and live in Adelaide. I'm 53 and my wife's 48, and we have 2.8 million in super currently, and both of us are on track to max out our transfer balance cap by age 60, and we own our own home outright, which means I'll have 2 million in super each. My daughter is 25 and her partner is 27. They're both living with us now and saving for a deposit for a home, and they earn about 190,000 between them, and they've saved $90,000 deposit so far. One investment property we own is in Adelaide, is owned in a trust, a family trust, I imagine. Purchased for 640,000, is now worth just over $1 million with $440,000 of debt. What do you think of the idea of selling 50% of the property to my daughter and her partner? They've been approved to borrow over $500,000. I'm thinking that we will have just enough money to pay for the capital gains tax and repay the debt on the property. They can live in the property and we can forego the rent on 50% of the property, but we'll have no expenses associated with that property. In 5 to 10 years, we can sell the property or they can buy the 50% off us. Is that a good idea? Okay, so the challenge when co-owning property with your children, and so the descriptor there is co-owning property with people at very different ages, is that it can be a real challenge from a lending perspective. So from a borrowing perspective, more correctly. So that is that the daughter's 25, 27 is the partner. So they're in their 20s. Let's fast forward in, say, 10 years' time, they're going to be in their 30s, whereas Pete and his wife are going to be in their 60s. Now, if they come to, refinance their loan, they're going to say, well, we've got 2 people here in their 60s that have an interest in this property and therefore have to be on the mortgage, because you can't have a property owned, 50% by a trust and 50% by Pete's daughter and her partner, and their partner and the daughter are only on the loan. All the owners have to be party to the transaction. Now, you can offer a security guarantee, but they've still got to be party to the transaction. And so then the problem then is you've got retirees that are applying for finance, and it's a 30 loan term, and the bank's got to get their head around that. And so you've got sort of people at 2 different stages of life, ages and stage of life. It can get really messy. So I reckon, I don't mind your idea. I think what Pete's saying is he's got 3 investment properties. They're going to have plenty of super. They've probably got more assets than they need. And so Pete's thinking, well, why don't I just sell this property? And that might be a way of helping my daughter get into the property market. So I think what I would do is I would sell the property to them. I'd sell 100% of the property to them. Now, I hear that they can't afford to pay for that, but you could say, well, I'll loan you $500,000 interest free. And together with the bank, they can borrow $500,000. They've now got $1 million and they can buy that property off you. And so the title changes into their hands. They've then got full control over it. But then there's a loan agreement between you and your daughter that she one day has to pay you back that $500,000. And she can do that either if and when she sells the property. You probably want to put that in the agreement. Or if they don't sell the property, it becomes part of the estate. The loan is part of your estate. And so, Pete, if you've got other children, that gets balanced out and it's kind of an early inheritance then. But that way they've got full control over the asset, full control over the borrowing capacity. The only thing here, though, is that when she goes to the bank, she can't really, she can disclose a loan, but maybe you'd say that there's no loan repayments or it's an interest-free loan, because the bank's going to have to work out or include it in their borrowing capacity. Or maybe she can just remain silent and say, my dad's going to sell me this property for $500,000. Because you could do that too, right? You could sell it to her for $500,000. There's nothing in the law that says you have to sell it to your daughter for the market value. Of course, you've got to pay capital gains tax on the market value. Of course, you've got to pay stamp duty on the market value. But there's nothing stopping you from selling the property for $500,000 to your daughter. But I think I would look for a way to at least transfer 100% of the ownership now, if that's what you're looking to do. That'll make it a lot easier for them to be able to deal with that asset on their own 2 feet. And then one day, if they go and sell the property, you get your money back, or ultimately it becomes an early inheritance. At least that's what I'd be thinking about anyway. Okay, next question is from Khalid. Khalid writes, it's always useful to listen to your podcast and consume the content you produce, be it in your books, podcast, or blog. I just finished reading your book Investopoly this morning, and it certainly had many light bulb moments in there. It's a great book to keep as a reference along with rules of the investing game. So thanks, Khalid. I really appreciate it. When I sat down to write Investopoly, I did want to write something that was timeless, although I'm contemplating potentially rewriting the whole book. But, if I get to find a spare 100 hours or whatever of my time. Anyway, Khalid writes, I have a small portfolio of shares and ETFs consisting of the following: FANG, which is US tech companies; GEAR, which is an Australian ASX 200 geared; Gold, which is a gold ETF; MVB, which is a Australian banks ETF; VAS, Australian share market; VTS, I think that's total US market. So he's got some ETFs there. Current value is 72,000, with FANG holding almost half of the portfolio. I'm sure you've seen the falling markets over the past few weeks, which is still taking place. So this must be a few weeks old, of course, because markets have almost fully recovered. But still, I think Khalid's questions are still really relevant. Is it a good idea now to sell some of the ETFs and buy some less risky, more resilient ETFs? Something I'm leaning towards not doing. Okay. Or should I play the long game and leave it as is so that I don't realize the loss? I'm still in my late 40s, earning a good income, so I don't need to sell and cash out. Well, Khalid, I think it's always good to start thinking about portfolio's future returns when I have an asset allocation. That's the most important thing to think about. Now, you might use past returns as an indicator to that, but there's always going to be times, particularly in markets, where certain sectors become overvalued. Now, then, does that mean that you should cycle out of those sectors and go into less, more undervalued? I think the answer is yes, but it's not a all or nothing decision, and it's really what they call rebalancing in a portfolio. And you don't want to do it too often, but you don't want to not do it at all, because if you don't do it at all, you're going to end up with a lot of concentration risk. And we know that all markets and sectors move in cycles, right? So you're going to go through a cycle that's going to be, a great sort of growth cycle. And then there'll be a cycle where, it'll fall in value, it'll underperform, et cetera, et cetera. And so what you should be doing is taking a little bit of money out of the sectors that are outperforming, and then take that money and take some of that money and rebalance it and put it into sectors or markets that are more attractively priced. And you should be doing that regularly. Now, when I say regularly, probably not more than annually. There's a bit of research that says the average kind of run or momentum in a stock or a sector typically on average lasts 9 months. Now, it can last a lot longer than that, of course. Look at CSL, had decades of great performance from a share price perspective, not so much over the last 5 years. It's kind of moved sideways over that time, but it went through periods of very strong performance. But when you look at study, overall about 9 months, you don't want to do it any shorter than 9 months, because you kind of miss out on that momentum. But every 12 months, you want to look at it and go, look, FANG is now too much of my portfolio. I'm going to take some profit out of that, and I'm going to put it into sector X. Well, you don't have any emerging markets in the ETFs that you showed me there, and they represent pretty good value at the moment. So I'd probably take some out of FANG and put it in emerging markets. But it's just an example. It's not advice, of course, but that's how I would approach a long-term approach to investing, so that you're not saying I'm going to sell FANG completely. What you're going to say is, this part of my portfolio has performed really well. Similarly with gold, right? I don't know when you entered, but I'd be wanting to be underweight exposure gold at the moment, because it's just, it might continue to climb, but I think it's a really good exit price at the moment. I think if you're going to look at 10-year returns, and that's what you need to be convinced of. If I'm in gold, what's my return going to be on average over the next 10 years? I'd struggle to believe it's going to be anything that's going to excite you, and therefore you should take profit, move it into a sector where the 10-year returns are likely to excite you. Okay, second part of the question is from Khalid. I heard either from you or someone else that the Asian and Japanese shares and ETFs are good value at the moment due to lower PE ratios relative to international stocks. Can you recommend some Asia-related ETFs on the ASX to look into and eventually buy? Well, Most of the Asian markets are what would be defined as emerging markets, and the bigger emerging markets within Asia are really China, of course, India, Taiwan, Korea, South Korea, of course. They're probably, the lion's share of it, really. Japan is regarded as a developed market. It's still pretty cheap from a PE perspective. The challenge I have with Japan is that it's kind of addicted to almost zero interest rates. And the Japanese central bank has been buying ETFs. Of course, most central banks just buy bonds in terms of managing interest rate, market stability, all those sorts of things. They've been buying ETFs, which is pretty unique. And they've got an aging population. It's probably all baked into the price, but, I'm not upset to be overweight Japan, but I think there might be more value in emerging markets. I like VEU, which is a Vanguard XUS ETF. I'm not suggesting, again, nothing in this podcast is advice, of course, and I'm not suggesting everyone should go and put all their money in VEU, but it certainly has outperformed just the global index over the last 12 months, partly because, what's been going on in the US. And I like VEU because it sort of excludes US, so it means you're overweight Europe, UK and Japan, but also has some emerging markets in there as well, so China and so forth. Anyway, thanks, Khalid. Thanks for your questions. Okay, next question is from Justin. Justin writes, in your Q&A podcast today on the 15th of April, so it shows that I'm sort of month and a bit behind, almost 6 weeks behind the questions. We've got a lot of questions, so that's great, but just let you know that if you do write in, it takes me about 6 weeks to get to your questions. Potentially, some questions are quite complex, but anyway. Sidetracked it. Okay, Justin writes, you mentioned that the cost base would reset to market value after the 6 years. And the question I should have said is in relation to the 6-year rule. But as I understand it, the cost base resets to the market value when you first purchase the income producing asset, when someone moved out and became an investment property. Could you please clarify which one is correct? So I remember looking into this a few years ago quite deeply, and it's actually the market value after that 6-year period has elapsed. Okay, so let me explain this in very simple terms. I go and buy a property, I occupy that property right from the beginning. This is an important clarification. So from day one, it's my principal place of residence. I live in it for 2 years. I then decide to go work overseas, and then I go and rent that property out. And then I rent it out for, let's say, 8 years, and then I go and sell the property. I sell the property when I'm an Australian tax resident. In that situation, I will have to pay capital gains tax on the market value of that end of that 6-year period. At that time, I've owned the property for 8 years. 2, I occupied it, and 6, I was absent but hadn't claimed another principal place of residence. And so it's the market value, the difference between what its market value was the end of that first 6 years of renting out and what I sell the property for. If it's a investment property, so let's say that I buy a property, it's initially an investment property, but then I move into that property and then subsequently move out and move overseas, but don't claim another principal place of residence, you would apportion, you still get the 6-year benefit, and you'd need to apportion the capital gains tax over a number of days owned of the property. And the key thing here with capital gains tax is whether at the beginning, when you first purchased the property, was it a home or was it investment? And it'll then tell you which method to use. But because that's something I always thought, if you don't move back in or sell the property before that 6 years is up, you kind of miss that benefit. It's not true. You'll still get the 6-year benefit, and you just need to apply whatever capital gains tax calculation is applicable in your situation. So, but thanks for the clarification question, Justin. Okay, next question. My name is Brian. It's a pseudonym. I'm not sure that was relevant for me to read out, but anyway, there I did it anyway. I sent an email for a similar question in December last year. Apologies if you already answered it on the podcast. Please point me to the podcast number if you didn't. If I do miss questions, let me know. I did search for it. I haven't answered it. Many thanks for your podcast, which has added tremendous value to me. Every other podcast is trying to sell their product or service. However, you provide unbiased information without hidden agenda. Hence, thank you so much. My partner and I would like some advice around our situation. It's highly likely that we won't be able to be clients of yours due to our low incomes and low net worth. which means it's unlikely that Pro Solution would add significant value compared to the cost associated with the service. Hence, I hope you don't mind if you could answer it here. So, Brian, thanks for your great feedback. I never want this podcast to be a sales pitch. I feel like if I say something intelligent and you need some help, I'm sure people can hunt down my business and reach out anyway. Also, unfortunately, we can't help everyone. We need to make sure that, if we need to charge a certain fee, that it's worthwhile for you to pay that fee. But I'm constantly thinking about, is there a way that we can deliver our service and advice at a lower cost, to try and help more people? But also, we've got to realize that in business, as soon as you want everyone, you want no one. And so you've got to find, what sort of niche that you're really there to service. But look, that's why I do the Q&A, because I guess it's another way of me kind of just sharing some of that information. Okay, let's get back to Brian's situation. So we're both in our early 30s, collective equity position of 250,000 in shares and crypto, a investment property in Brisbane that they bought about a year ago, about a $900,000. It's worth $900,000 with 770 mortgage, a 4.3% gross yield, 250,000 sitting in the offset account against the Brisbane investment property, some allocated for a deposit for another home, some allocated for, travel and enjoyment. Currently rent investing from Melbourne, no principal place of residence, happy to rent for the next 3 to 5 years and then be looking for a principal place of residence. Incomes, Brian 180, partner 160. So pretty good incomes, I must say. Partner will likely have scope for increase in income. Super is $250,000 collectively. Monthly surplus cash flow is allocated $3,500 to property, mostly eaten up by Brisbane investment property repayments, $2,500 into index funds, which can be reallocated property if appropriate, and then $4,000 to large ticket discretionary spending like travel and those sorts of things. Borrowing capacity at the moment is $750,000, but would be able to comfortably make repayments on about $650,000. The current problem is that they're unable to afford a forever home in the middle ring eastern side Melbourne suburbs, likely need $1.5 million. So the question is, what do they do? And the three options that Brian's put there is that with the borrowing capacity about $650,000, purchase a stepping stone principal place of residence in Melbourne to catch the growth cycle, but sacrifice on quality, such as purchase a townhouse or unit in a good middle ring eastern suburb of Melbourne, then hopefully sell in 5 years to purchase a forever home, or a stepping stone investment property in Melbourne, house on a large block, but in the outer to middle ring suburbs where they're not really willing to live, and then sell to purchase a forever home. All three, just invest in shares and hope the Brisbane property grows. Out of those three options, and I think they're all pretty good options, I think I would go with the first option. So I think I would try and get into the Melbourne market as soon as I possibly could. I'm not sure 650 is going to do it, but look, you've got 650 plus the 250,000 in the offset account. So that sort of takes you to 900. That's going to get you a good villa unit. So I'd buy a villa unit, not an apartment, not a townhouse necessary. Townhouse typically is going to be built in the last 30 years, where a villa unit could be like 60s. Buy something that needs a little bit of love and attention, something that needs kitchen, bathrooms, just cosmetic stuff, nothing structural or anything like that. It needs to be structurally sound. Something you could buy in a good suburb like Glen Ira or something like that. You talk about those sort of suburbs, you can find those sorts of properties. They're quite common in those areas. And you can do up the property while you're living in it. As I said, do kitchen, bathroom, paint, flooring, that sort of stuff. Really spruce it up. Hopefully enjoy the growth cycle over the next 5 years, which I think is, nothing is for certain, of course, but I think highly likely to occur over the next 5 years. And you don't know where that's going to take you, right? It could be put you in a position where you can then leapfrog into the kind of the forever home. But I think that's sort of sacrifice in terms of getting something with smaller accommodation but well located. I mean, it's still going to give you the lifestyle benefits, which are good. It might not give you the room that you would normally desire, but it's probably the best decision that you could make. The alternative is, and that, I'd say that because you're trying to get into the Melbourne market, because the risk is that if you don't do anything now, I think Brisbane will still grow well, and that's fine. But really, you need to use after-tax dollars to get into the Melbourne market. So even Brisbane growing over the next 5 years isn't going to help you necessarily unless you sell that property. Shares, I mean, they'll probably perform, I mean, they could perform okay over the next period of time, but that's your risk, is that Melbourne property grows at a faster rate. So I think you really need to get into the market and get that foothold, buy something that is mostly land value in a good location, make some improvements to it, and then hopefully, together with the equity that you can manufacture by making those improvements and the market uplift, gets you in a position where you can buy your forever home. Brian's added another just added to question, if you like. He writes, you mentioned on the podcast that increasing the budget for a investment property or home will increase the quality of the asset, hence better returns. Why would a more expensive house, that is something more than $1 million, provide better returns compared to a cheaper, lower end house for, say, 500, 800,000? I understand that the absolute value returns will be higher for the more expensive house, but would the percentage returns not be similar? If not, why? What are some of the other key indicators of investment grade asset? Well, I did an episode on investment grade property back in March 2023. The blog on the website is called How to Buy the Highest Quality Property Within Your Budget. And there I talked about persistent imbalance of supply and demand, evidence of past growth, and a strong land value component as kind of the three attributes that we should really look at, which kind of answers the first question as well, as why does spending more get you a better quality asset, and why will that better quality asset outperform from a percentage perspective? The answer is really supply and demand. That if there's plenty of houses in the $500,000 to $800,000 mark, and one idea of thinking is that I should buy in that sort of price gap because that's where the most of the buyers are. But most of the buyers in that 500 to 800,000 price range, their capacity is restricted mostly by their income and their income growth, which is pretty stagnant, right? Income growth in Australia is sort of 3, 4, 4-ish%. That means property prices can only rise at really 4%. Whereas what you want to do is invest in an area where property price or affordability isn't so strictly linked to just household income, that there's other contributors, business, inheritance, other sources of wealth. And so if I'm looking at a really blue chip location, typically the buyer in that isn't going to be just restricted by the average Australian change in household income. And as a result, the people that want to buy here in that location in 10 years from now will have more money to be able to pay for the property. So more than what a general rise in household income has been on average. And that's why buying in a location where, really it's not buying a diamond, it's buying a pink diamond, if you like. And it's really about then buying an area where there's an imbalance of supply and demand, where there's a strong land value component, where a property has some uniqueness associated with it. So a really good example would be, and you don't need to be in Sydney to understand this, but if you buy an apartment in Sydney, whether it's Bondi apartments tend to do really well, that has a water view. It doesn't have to be spectacular water view, but something with a water view. Now you're going to have to pay maybe $500,000, $1 million more for that apartment than something that doesn't have a water view. But the point is that it's scarce. Everyone wants, there's always going to be someone that's prepared to pay a little bit more to get that view because it has the uniqueness. That's really what you want in a property, an investment property, some sort of uniqueness. Now, that doesn't have to come in views. It can come in terms of locality, in a particular street, on a particular side of a street, in a particular location. These are the sorts of attributes you really want. And so you often have to pay more to get into that asset, but you'll get the premium when you exit the asset as well. And that's why spending more, as long as it gets you a better quality asset, doesn't always, but as long as it does, will generally generate a higher return. Okay, so thanks for your questions, Brian. I hope that's been helpful, and good luck with everything. Just a reminder to register for the YouTube live event tomorrow at 7 p.m. Link is in the show notes. Until tomorrow, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.